Thank you very much. Thank you very much for the invitation. First of all, it's a very great honor to be here. Thank you very much for all the great setup. This is great. So, I'm Yuji Doi. I work with a company called Kajima, which is a global construction company based in Tokyo, Japan. I'm kind of leading the innovation side of the business, trying to really reimagine what's going to be the future of the built environment going to look like, and finding some partners, great partners with an innovative company to lead that kind of effort. So, as we are a construction company, we kind of touch upon most of the area in the construction, which coming from different type of the projects, for example, commercial, residential, industrial, all the way to the infrastructures, as well as different phases, right? So, from the early real estate development side, from the design, architect, engineering side, as well as into the construction. Also, we look into the post-construction phase as a operation and maintenance as well. So that's kind of who we are. We operate globally as well, so not just in Japan, but also in North America, Southeastern Asia, Europe, and Australia. Also, we have a strong R&D effort, so we have been investing a lot in the internal innovation, and these days, we opened up this open innovation platform to really look into more of having the help from the innovative company like that. So that's kind of who we are.
You took away my first question.
Oh, I'm
So,
sorry about that.
well, if we could give a little bit of background about yourselves individually and what your background
About
is.
60 seconds.
Okay, yeah. Great.
Hi, my name is Sudhir Kadam. I'm a venture partner at FYDA Growth Partners. I'm also an advisor to Techni Infinity Venture Fund, where we groom hospitality startups. I'm also an advisor to Silicon Valley Syndicate Club. Largely our investments are syndicated investments. I've been an entrepreneur all my life and then switched over to advising and investing. And we largely invest in B2B startups, which are high tech, typically into AR, VR, into AI, NLP, and so on. I'm a regular panel member here at David's events. And one of the events that we did in 2019 on Google campus, David, if you remember that, the startup that won that competition just got a funding of 7 million recently. Okay, it's a Swiss startup. They moved to Silicon Valley and got a 7 million funding. Okay, the best way to learn is to teach. So I also am an adjunct professor at San Jose State University for entrepreneurship and innovation. I also am an advisor for digital marketing at CSU Chico, and I also do programs for EMBA Consortium all over the world. Thank you.
Hi everyone, my name is Nikolai Oreshkin. Thank you SVE and FPT for having me here. David is an old friend. We've been working together for almost a decade. In 2017 I started Elysium Venture Capital. It was an early stage fund. Currently we manage multiple funds. Two of them are active. Early stage fund is $20 million fund. Growth stage fund is $120 million fund. And total asset under management we have slightly over $500 million. Last year we had 3 companies that went public. This year we had 2 more companies that were listed on NASDAQ. Look forward to hearing your pitches. Thank you.
Thank you, Roger. I used to have questions about lawyer until my daughter went to law school, then I still didn't like them any much more. So, hello everyone, my name is Eric Tao. My 2 legs, one leg in the dark side of academia, the other leg is in the bright side or dark side of the venture. Depends on which one you like. So our venture fund focuses on very niche area. It's AI enhanced health technology or AI enhanced education technology. The reason why we do that is that because my connection back to California State University and UC, so we can uniquely identify and also help the early stage company in those areas, AI-based health tech, AI-based edtech. So we are looking for someone that wants to connect both the VCs and also the research community that give them a unique connection between both sides. So hopefully I will hear a wonderful presentation and find a way to collaborate with all of you, Randy definitely, and some of the entrepreneurs.
Excellent, thank you. So Question for the panel. Are we in a nuclear winter for funding? And if so, when is this winter going to end?
You know, certainly capital became more expensive for both startup founders and for VCs, for institutional investors, because you see the downside of the stock market. But I believe that it is a good opportunity to start a startup, especially for early stage startups, because you know, when there is a bigger competition for funding, there is a bigger talents can raise up. Next year, I believe that we'll be hitting some kind of bumpy stage, but by the end of 2023, hopefully we'll get into the stage where we see some talented entrepreneurs who started successful companies, funded startups.
I think that's a great point because I see startups being able to attract talent. You know, in 2001, 2008, that they really wouldn't have been able to attract in a booming economy. So, you know, starting a company and getting that talent that you may not otherwise have been able to get is a great opportunity.
Yeah, so, you know, the public market works very differently from the private market, okay, and that's the key difference, okay. When the public market is going through a downturn, you know, you will see a lot of investment that happen in the private market because we want to be in that ebb mode so that when the economy comes up, you know, so there is always the boom and bust, right? What is the bust now will turn into a boom in about 18 months' time, right? So you see early 2024, and the investments you make now are going to fructify at that time, you know, and the startups will be on that growth curve. Okay, so if you can position your investments properly, this is a good time. The other thing that is happening is, you know, because of the valuation hit that is occurring, okay, it's easy for investors to invest now and get a bigger chunk of the company, okay. And the third thing is, a lot of M&As are happening right now. A lot of consolidation is happening because some of the startups will not survive this bust, right? So there are a lot of mergers and acquisitions that are happening, you know, which is a very interesting play from an investment perspective also. So I think, you know, there is a winter, okay, but there are warm rooms available during the winter also.
Also, number 4, we shouldn't underestimate people who get laid off recently from Twitter, and they're professionals. They're professionals who don't want to go to work for corporates. Some of them may start their own companies, and that's the opportunity for VCs.
What's your experience, Eric?
I always tell my LP and my investor friends that during the recession or during this difficult time, it's the best time to invest. Your money worth a lot more of the shares of the talent of the entrepreneur. So don't despair. We know the good time will come. But according to, depends on how you look at it, the fourth quarter, I think the market will go back. So not too long, 9 months. So, but for entrepreneur and for investor, the downtime sometimes the best time to invest and to start because you can get more talent, you get more share. If you look across many of the great companies, many of them are starting at difficult times.
And Yuji, what's your view?
Yeah, more from the corporate perspective, I guess, you know, obviously this is pretty much a headwind, but you know, I think how we can very much prepare in this kind of winter, you know, time, it's going to be much more important. So maybe, you know, when you try to find, you know, corporate partners that you want to, you know, work with, you might have to very much be careful what kind of corporate they are, because obviously, you know, people might be more, you know, passive, whereas they were more aggressive in their, you know, when the economy was good. So, you know, there might be a good way to, you know, figure out what kind of corporate that you want to work with. You know, I'm not sure which side of a company like we are, but we are trying to be more on the aggressive side to, you know, learn from this, you know, winter time and then be prepared for the, you know, the warm spring to come.
You know, a number of you mentioned, you know, decreased valuations. Anecdotally, I haven't really seen that with my clients. The fundings will be pretty robust and pretty robust valuations. Not as many fundings, but are you typically seeing, you know, in the last quarter, significant hits to valuation
For early stage companies, I didn't notice. Let's say if you take average YC type of company, they've been always very expensive, and they're staying. They're preparing to stay. The same as we didn't see much down rounds. On the public markets, obviously a lot of companies went down, but in price per share. But on the private markets, not many changes. Just capital became more hard to raise.
Yeah. I think where I've seen the decrease in valuation is at the later stage, but at the early stage, I just haven't really seen it. What's your experience?
Yeah, see, the earlier, a lot of investment would happen on FOMO, right? Fear of missing out, okay? And everybody's investing, why am I not investing? And the valuation would shoot up, okay? So that's not happening. There's a lot of sanity in the market now. And the startups are being measured for the valuation in terms of what are their foundations, how strong are they? How are they able to overcome some of these things? So we are going back to basics, okay? We are looking at the performance in terms of financials, in terms of growth, and it's not, the hype element is being eliminated, and that's where you will see the companies which are hyped up would see a valuation hit. But companies who have strong fundamentals, they will, so the smart, the founders are very smart. They say that, okay, I'm not going to invest at this, raise money at this valuation, okay, because I know what my company is. And if they come up with such confidence to the investors have no choice but to invest, because there is so much of money still lying around which got to be invested, right? Because otherwise it will lapse.
So just a quick question. I assume that everybody here, the entry point as an investor is very early stage. Is it pre-seed? Is it pre-A? Maybe you could just give us a quick, maybe we'll start with you, Eric. You just tell us what your entry point is for investment.
We are at the seed level, so our panel of expert can help to direct your technology. So we don't do later stage because kind of the path already set. So we do early stage, kind of seed level or pre-seed level.
So what is seed? Is today seed a $5 million round? Is it a $1 million round? What's your sweet spot?
It's about 1 to 2.5 is kind of the sweet spot for a seed.
Thank you, Roger. Yeah, we have two funds. For early stage funds, we invest with a check size up to $1 million, and it can be from idea stage. Obviously, we do not invest in first-time founders with idea stage. Or it may be first-time founders, but let's say if it is, you see Berkeley alumni who worked 5 years in Google, and then all of a sudden decided to start a startup. I want to be the first in the line to meet him. For growth stage, we invest with the checks from 3 to 15 millions. Usually, last deal we closed was $40 million came from us, and typically we look for companies with a 10 million plus ARR.
Yeah, so in the early stage, we go with an accelerator fund, which is we invest about $50,000 in each startup that comes into our acceleration program. For a later fund, like let's say it's pre-seed, okay, I'm not even talking seed now, okay, pre-seed. It's anywhere from $250,000 to $500,000. That's our max cap, and it's indicated, okay, across the board. But there are instances. We recently invested in a pharmaceutical company. That's a Series B company, okay. But we could see a substantial valuation growth, and so everybody wanted to play there. Okay, so it's
Good time for one more.
Yeah, just last
Just to give the entrepreneurs in the room something to take away, as well as everything else that's being said. What's the biggest mistake that you see founders making in funding?
I usually take a big session on startup fundability. Okay, so one of the things is articulating your value proposition. Okay, which is where I see most of the startups are not able to make it. Okay, so unless you are able to articulate your value proposition properly to the investors, to your future employees, to your parents at home, right, and to your partners, you have no startup there. Okay, you have no startup because it has to be of value to somebody. There has to be value creation, which you should be able to articulate. Value creation for the customer, value creation for your own company. Okay, that it creates value for your own company. So it's all a game around value. Okay, so there is value proposition, there is value creation, there is value delivery, and there is value capture. Okay, so you have to remember that unless you are able to meet what I call as a value equation, where the value, the value that you offer to the customer has to be greater than the price the customer is paying to get that value. Okay, you should be able to capture that. Okay, so that is really vital, and you should be able to show. See, a lot of startups, this is one of the things that I find in fundability. The startups have maybe one or two customers, and they think they've got a product market fit. Okay, and that's the biggest blunder you can do. Go to an investor and tell them, I got these two customers and I got a product market fit. Product market fit has very clear definition. So, and the VCs know that very clearly, right? Unless we see, that there is a real product market fit, and then the founder doesn't understand, then there is a gap, right? Is he a right founder to invest in?
Anyone else with pearls of wisdom?
Sudhir, we have a little bit different approach. We are not looking specifically for product market fit. I'd say for us it's much more important founder market fit. When founder knows what he is doing. And in terms of the mistakes, what companies are doing during the fundraising, we typically as a fund are doing 4 types of due diligence. It's a product, technical due diligence, then financial due diligence, corporate and legal. And the common mistake that we've seen is in the corporate side. When you look at the cap table and founder on a before the Series A gave up 65% of the shares. So he technically do not own this company. And he gave away 10% to advisors, 10% to early stage investors, then a lot of random stock just disappeared, and that's kind of common mistake.
Great, well thank you. Eric, you wanted to say one quick thing?
I want to echo that. Choose your early partner carefully. I have many, many wonderful students. They will have a friend say, oh, you'll get half. The second day, the half disappear. Then what you do is the half. So choose your early stage partner very wisely.
And have vesting.
And one more thing, read your term sheet carefully. I've been seeing very ugly term sheets coming out these days, okay? And the founders are in a fit of excitement, ready to sign the term sheets without understanding the implications of that. So read your term sheets very carefully.
Great, thank you.